Welcome back, Yield Nerds, for the first Yield Nerd episode in 2023. And there is something interesting going on. There is actually a riddle for us to solve. So let's talk about what the riddle is and why the riddle is in place. We're going to review a couple of highlights of the minutes from the latest Fed meeting and superimpose a couple of curves we've been talking about all along and see if that tells us something interesting. My usual disclaimer, I am not giving you investment advice. This is education. I am learning with you. I am not a wealth management advisor. I do not have any ulterior agenda to sell you something, merchandise. That is not my deal. All right, let's look at the agenda. The first thing we're going to do is review a couple of highlights of the latest minutes from the Fed. This forms the basis of the availability of funds, liquidity, and so on, which indirectly also affects the entire economy. We'll then play our favorite game, the Yield Super Bowl. If that term is not familiar to you, you should go back and see some of the previous episodes. Here is a pointer to one of them, and you can start picking up from there and watching that to review what the Yield Super Bowl is. The next thing we're going to do is, for the most part, we've been comparing one yield instrument with another. This time we're going to do something different. We're going to take the same yield instrument, treasuries, and look at how that yield curve has changed over time to see if there is anything going on. Hint, hint, there is something very interesting going on. And that we'll call the riddle, and we'll talk about what are your next steps based on that riddle and based on our understanding of what that riddle, what the solution to that riddle is. Couple of things for new visitors, first-time viewers. There is a playlist in the show. Here is the playlist. And if you would kindly look at the playlist, it organizes the entire show in a sequence that builds one on top of the other. So if you're jumping in and some of these terms such as yield curve and personal yield curve and yield Super Bowl, if those things don't make sense, feel free to use the playlist. All right, let's talk about the latest Fed meeting minutes. The word that was used all over the place is flexibility. What the Fed is saying effectively is we may increase the rates, we may not increase the rates. We're just going to go where the market takes us, but we're going to focus on inflation and our 2% goal, and that is what is going to guide us. And a very big aha moment that came about is that none of the participants in the FOMC committee, none of the participants said it is time to decrease. It is time to reduce the federal funds target rate, which means the rate is pretty much going to go up gradually, or stay flat. It is, as of now, unlikely to come down. So the message that is being sent is that don't sit here and think that we are going to pivot. We are not going to pivot, not in the near term anyway. And that is the goal, that is the key message from the Fed. And with that as the backdrop, here's what we do. We compare all the various popular fixed income instruments, treasuries, agencies, muni bonds, and corporate bonds. And we'll take the 3-month treasury, compare it with an agency bond, which has 3 months to mature, compare it with a muni bond and a corporate. And then we'll do that for 6 months, 9 months, a year, 18 months, and so on. And we call that the yield Super Bowl. And when you compare that, you kind of are able to construct your own yield curve. What I mean by that is you may live in a state that has a certain state tax. Some states have zero state tax. And if you listen to some of the previous episodes, you will know that certain agency bonds and treasuries are state tax exempt. So we're going to bump up the yield by the state tax for those. Muni bonds are federal tax exempt. So we're going to bump up the muni bond yield by the federal tax rate. And we'll play with a couple of different federal tax percentages, a couple of different state tax percentages, and so on. And corporates, we're going to keep them as is and compare them to each other. For some of you who may have seen earlier episodes, you may know that there are some agency bonds that are state taxable. Watch out. Some muni bonds are taxable in some states. And so it's not completely tax-free. If you buy a muni bond in your own state, some states say, okay, we won't tax you. Other states say, we will tax you. And last but not the least, my philosophy is to use effective tax and not marginal tax. And some of the previous episodes discuss why I do that. So feel free to watch that as well. Couple of things before we get going. I am not your tax accountant. I am not, telling you to do something based on one tax or the other. This is education and not advice. Okay, if you remember the previous episode, this goes back almost 2 months now. What we saw is that in the 0 to 6 months, treasuries are king. In the 6 months to roughly 3 years, agency bonds are king. And if you then went past that, you got the corporates at the longer duration, and then munis were holding out in the really long duration for people at the 28% federal tax rate. And if you own a yacht and you own 6 houses, you probably aren't listening to this show. But if you are listening to this show and you own a yacht and you own 6 houses, munis may make sense for you at a shorter duration. Otherwise, it just doesn't look like they were attractive as of November 2022. Well, let's look at January 2023, hot off the press. Once again, treasuries dominate, except treasuries now are the best buy all the way until a year in duration. Some of this is clearly because the Fed keeps increasing the rates, so treasuries look better than any other alternative on an ongoing basis for a longer duration. However, agency bonds are not being left behind. There are plenty of good agency bond choices. Look at this one. This is almost nearing 6% pre-tax. Remember, pre-tax, so we bump it up by state tax here. And so agency bonds are very attractive all the way until 3-4 years. And all of them kind of sort of converge at 5 years. And in the very long duration, munis once again come in. And in this scenario, we are comparing one yield instrument versus another. And as I said, we can just sit here and say, well, things haven't really moved between November and January. And so I don't know what the big deal is about the Fed announcing that they're not going to pivot. Life looks the same. And if you concluded that, get ready for a little bit of a surprise. Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. If you look at treasuries, and you can go back to Yield Nerd's very, very early episodes, those in early September, we made the observation that the yield curve is inverted. Oh my goodness. The government wants you to hold shorter duration. They reward you more to hold shorter duration than longer duration. And you notice that the peak is about 4%, and this was in November 2022. If you then go to, that was in September 2022. If you then go to October, notice the 4 is now 4.5. So there's some very interesting things going on. You can get a much higher yield. And not only that, the duration inversion is now slightly past the year mark, and it's closer to 18 months. And that's in October 2022. And based on the latest Fed news, which is that they are not going to pivot, if you look at January 2023, rates are still going up. We are now inching at almost 5%. But look at the point of inversion. The point of inversion is now 6 months. What does that mean? And you can again look at this and say, well, the yield curve is inverted. Maybe there is really nothing to see here. But what if we laid the treasury yield curves one on top of the other? Will we see anything different? Let's do something simple. We're going to overlay September on top of October. And in a rising interest rate environment, this is what you would normally see. The October curve uniformly is above the September curve. Makes a lot of sense. For every duration, if you wait it, life is good, you get higher yields. And so this is a very normal show, which is why the kid on the right side is yawning. Boo-hoo, big deal. September, October looks very consistent. And now we're going to overlay 2023 after the Fed announcement. Drum roll. Check that out. What does that tell you? In 2023, long-term yields are actually falling. Not only that, long-term yields now are lower than they were in October of 2022. How could that possibly be? You have higher interest rates across the board, and yet long-term yields are dropping. If you want to stop and think about that, and perhaps you want to pause the video and say, why is it that I am being rewarded less now to hold treasuries for a longer term than before? Here are the two most logical reasons. Number one, demand for longer term treasuries is now much lower than even 3 months ago. Why would demand be lower? There are two reasons why demand would be lower. The perception that I don't need the safety of the long-term federal treasury bond, I can go buy something else. What do you think that something else is? It's a riskier asset. The riskier asset could be preferred stock, it could be common stock, it could be dividend paying stock, it could be anything other than the gold standard debt. So in a way, the market is kind of calling the Fed out and saying, well, I'm going to try and take more risk, especially in the longer duration. And the second thing that is happening is, as the Fed keeps jacking up the shorter duration funds rate higher and higher, the market is saying enough of holding longer duration, I'm just going to dump it and jump over to this side. The combination of some amount of risk taking and jumping to lower duration means there is a lot more demand here, a lot less demand there. Less demand means in an auction, the Fed will try to offer you a higher price, but at the end of the day, nobody wants those bonds. And if you don't want the bond, then you kind of start seeing a lower and lower demand. So let's think through what this message says. In all likelihood, the market is calling the Fed saying, you really are telling me that you're not going to drop your federal funds rate in 2023? And if you read the latter part, the commentary of that Reuters article, it says, over the first quarter, we're going to do another 50 basis points. The market says we still think the Fed will cut rates before the end of the year. Will it happen? Will it not happen? I couldn't tell you. But this is what rate-based traders, hedgers, are doing. And what they are saying is they are going to begin cutting the rates in the latter part of the year. If you know rates are going to be cut in the latter part of the year, what will happen? If you already own short-term instruments, you can take that cash and deploy it. More importantly, there is another phenomenon that people always think they are geniuses in predicting, and I'm not one of them. I'm just a yield investor. History indicates that 6 months before the inversion of the federal funds rate is the absolute bottom of the market, and the bull run starts when interest rates start dropping. So there is a chance that if all the interest rate hedgers are saying there will be an inversion this year, they also are whispering to themselves, and therefore let me dump longer term treasuries and move over to equity. Whether you want to do that or not is up to you. My humble yield nerd advice to myself, and you do what you want to do, is for those of you who believe you are the absolute genius and today is exactly 6 months before the market is going to turn, before Fed funds rate starts dropping and the bull run starts, sure, you can ride up the 228%. The thoughtful yield nerd will say, I'll just wait a couple of months. I'll just see what happens. If the market truly turns and stocks start appreciating like crazy, I can jump in 30, 40% later. And instead of 228%, maybe I catch 100%. But I don't need to rush in now. That is what a thoughtful nerd would do. You answer the riddle how you want to, but the sensible thing to do appears to be to continue to maximize short-term income because the 0 to 1 year treasury rate is just absolutely amazing. And perhaps feast on some 2 year treasuries, maybe agency bonds, and for those of you who are really, really, daring, maybe some equities that you believe, or don't have a lot of debt because interest rates are still rising and have good potential and are severely depressed, and you will know your appetite for that. I used a lot of spreadsheets behind the scenes to come up with these curves. If any of you want those spreadsheets, I'm happy to share them with you. Here's my email. Shoot me a note and look forward to collaborating with you. I hope you liked solving the riddle in early 2023. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.